everyone. Are you all well? Thank you for sticking by. Okay, so let's begin. The topic that we're about to be discussing in this panel is controversial. It is considered by the environmentalists as the wild, wild west. It is not understandable properly. And there is a reason why not everyone understands it. It's because it's super complicated. First of all, there is no standardization to calculate carbon or to buy carbon credits. There is no technology yet, or there is a technology, but it's not been fully utilized to understand the transparency. And frankly speaking, when you're buying carbon credit, you don't know the quality of the carbon you're buying. And hence, you might be at risk of greenwashing. And when you are buying carbon credit, you might be buying someone else's carbon. So there is double, I forgot the word, but you know the word. Anyways, but before we begin, why should we care? Why are we all here? We should care because if you are an organization in the Middle East who is dealing with the European markets, by law, such as the CBAM, such as CSRD, you will need to start calculating and buying carbon credits and reducing and genuinely meeting your net zero agenda. And this is why we're here now as a panelist. So my esteemed panelists, they represent the regulators, they represent the technologists, they represent the investors, and they definitely represent the founders of startups who are helping to solve this issue. So without further ado, let's begin the introduction. So Anna, I'm going to start with you. Would you like to introduce yourself?
Sure, thank you, Gihan. Many thanks for having me here today. It's a real pleasure. My name is Anna Campbell. I'm a director in the markets team at the Financial Services Regulatory Authority here in the ADGM.
Thank you, Anna.
Hi, hi everyone. My name is Aaron Blumgarn. I'm the founding partner of Climate Finance Partners. I've been involved in carbon finance and carbon markets for about 25 years, successfully deploying several $1 billion across both illiquid and liquid assets in carbon markets. So, pleasure to be here.
Thank you. Ivan?
Hi, everyone. My name is Ivan. I'm co-founder of Offset 8 Capital, founded in ADGM at COP28 in partnership with FundRock. We announced the first carbon credit fund in the Middle East. The fund is seeking to finance nature-based solutions in Africa and Southeast Asia.
Toddington?
Good afternoon, everybody. It's a pleasure and honor to be here. My name is Toddington Harper. I have a lifetime in sustainable energy, starting with parents who are building solar energy and battery projects in the deserts of Abu Dhabi, Russell, Kayma, and Al Ain 48 years ago. I'm back here having built the most successful electric vehicle charging business in the United Kingdom. We're charging more than 250,000 vehicles each month with more than 6 million kilowatt hours of clean energy. We're here to move the needle on climate change from Abu Dhabi with a business called Gigatons. The world needs to deliver around 59 gigatons of carbon emission reductions to keep the 1.5 degree number possible. I do that as co-CEO with my brother, who also leads the business with me from the other side of it. And we announced at Abu Dhabi Finance Week that we are here in Abu Dhabi, our business headquartered in ADGM, and we're going to mobilize $100 billion over the next decade. Mobilize and tokenize $100 billion over the next decade into net zero transport infrastructure, into AI infrastructure, into blockchain infrastructure, and we're going to do it with speed and scale. So it's absolutely incredibly exciting to be here, and we're going to tokenize every carbon saving that we deliver. We're going to tokenize, we're going to prove it, we're going to make it transparent, recordable, highly verifiable, and this is the place to do it. So I'm really excited to be here.
Thank you. And to finish off the intros, my name is Jihan Hyde, and I'm the CEO of Communique. We are a UK-based ESG consultancy. And what we do is we help you to communicate, not to communicate, to engage effectively with your supply chain ahead of your decarbonization process, and also to communicate your commitments clearly and concisely, but most importantly, to upskill your employees to understand what role do they play in your ESG commitment and sustainability initiatives. So thank you for having us. So let's begin. I'm going to start actually with the regulator. Sorry, Anna. Okay?
No problem.
Let's begin with you. So we all know that ADGM is curving the way. And my question to you is, can you explain why ADGM was the first to regulate carbon credits as the financial instrument? And how has this positioned you as the leader in this market? Or in this space, sorry.
Well, part of our job as the regulator is to monitor and keep abreast of market developments. So whether that's a new financial activity, whether or not that's a new product, we're watching the markets all of the time to see what developments are happening out there. We also listen and respond to the need for new regulation from our market participants. So in the carbon space, we saw that from both sides. We saw the market developments, particularly with all jurisdictions making their reduction commitments, and we had entities that were already operating in that space or wanted to move into that space that wanted regulation to cover them. So what did we do? We widened our definition of financial instruments to incorporate a new asset class, what we call environmental instruments. It's a very broad asset class. It includes both carbon emissions and carbon credits, so that means that our jurisdiction allows for both compliance and voluntary markets. And we also recognise other instruments that attest to the environmental attributes of an underlying unit. So that has enabled us to recognise renewable energy certificates, for instance. So we are the first regulator globally to take this step and to introduce regulations and rules in this regard. And it's also enabled firms that want to operate as regulated entities in our jurisdictions to do so. So they can trade, clear, settle, and do a large range of intermediary activities, so custody, broker dealing, and advising and arranging, which Ivan, I'm sure, will talk about a little bit later. Offset 8 is one of the firms that are licensed in our jurisdiction.
Thank you. Thank you. Erin, to be honest, it is so difficult to understand the difference between voluntary and compliance markets, okay? And I would love if you could simply put, differentiate for us, what's the difference between the voluntary market versus the compliance market, but most importantly, why is it important for the Middle Eastern markets in general?
Yeah. Well, thanks for that. And first, I want to congratulate Abu Dhabi and UAE. A year ago, at hosting an extremely successful COP last year, we were here. We were extremely inspired, and it's inspiring what the regulator has done. And we heard this morning Abu Dhabi wanting to be the center of climate finance. And this is, I think, a key point that I want to leave you with, is if we're serious about climate change, and wrapping our hands around climate change, and we're serious about mainstreaming climate finance, really, there is one way to do that, which is pricing carbon. Right? We need a price on carbon, and that will have an impact, pricing impact across the economy, make the clean, green investments that we're trying to do more attractive, make emissions more expensive. That is using the market mechanism to drive the kind of decarbonization, the type of change that we need. So how do we do that? There's really two fundamental ways. One is through a carbon price, the other is through a carbon tax. And when you look at the carbon pricing, there's voluntary and compliance. So coming to your question. A compliance market is a regulated market, typically through a cap and trade program where there's a cap on absolute emissions that goes down over time. The regulator issues emissions allowances, which is essentially the currency of the carbon market, and those can be traded among entities who have to comply with that regulation. This market is based on a long history of successful environmental markets, starting with the acid rain program in the United States back in the 80s. And in carbon has been trading for over 20 years. Compliance markets are a mature market. There are a $900 billion traded market. Largest markets are the emissions trading system in the EU, California, RGGI in the northeast of the US, the UK, and then we've got emerging markets happening all around the world now in response to things like CBAM, Article 6, which will, of the Paris Agreement, which we'll talk which we'll talk more
I love
about.
a CBAM. I do like the CBAM regulator, I have to admit.
So, and then on the voluntary side, some interesting things that are happening there. And frankly, this is what most people hear about when they learn about carbon markets. They're hearing about voluntary carbon markets. And those are typically driven, the demand there is driven by large corporations who are using carbon credits as part of their decarbonization or climate strategies. Think the Amazons, the Microsofts, et cetera, of the world, who they're trying to decarbonize. There's residual emissions that they don't have the technology or financial capability to reduce. And so they're using carbon credits, typically coming from carbon offset projects to address those residual emissions. Very interesting market, but this is the market that has had challenges over the last few years. It's a much smaller market, and that's, I think, the key point to make and for people to go home with, is voluntary carbon markets are maybe a $2 billion market. So compared to a $900 billion market in regulated markets, where there is no option but for regulated entities to purchase allowances, and then voluntary markets, much smaller market. Now, last point. Interesting thing is what people are calling about is are talking about is the integration of voluntary markets, or the incorporation of voluntary markets into compliance markets. And I think we'll talk more about Article 6, which was one of the main outcomes of the last COP in Baku that just ended last month, which is some resolution on what's called Article 6, which is the component of the Paris Agreement which governs the trading of carbon units between countries and within markets.
Yeah, but the reporting is still weak on those. I mean, one of the challenges we're facing at this moment of time is that it's a voluntary reporting. You don't need to report and disclose what you're actually doing. Is that correct? I mean,
no, it's the opposite. In compliance market, the reporting is very rigorous. It's
from a compliance, but from the voluntary market, I mean.
The voluntary market, there's been challenges with one could argue that voluntary markets are one of the most transparent markets in the world, right? You have to publish your project documentation, you have to go through third-party verification, but what is true is that there have been instances of gaming the system, right? There have been the standard setters are typically nonprofits. They're not professional regulators, even though they're well-intentioned. But there's been an opportunity in certain instances for project developers to let's say design their own baseline to overcredit. And there's been instances of overcrediting projects. And so I think as one of the hopes is, as those voluntary carbon markets move into a more compliance framework, that problem is addressed, right? But I would say it's also very important for investors in this space, and those are both who are buying credits, corporates who are buying credits, or those who are investing in credits, to really work with credible, high-integrity counterparties who've got experience in this space.
Well, speaking about investment, Ivan, at this moment of time, the preference for investing is in nature-based projects. Why is that?
It's very simple. To elaborate on what Aaron said, voluntary markets could be visualized in very simple 2x2 matrix. So on the horizontal axis, you would have engineering and nature-based solutions.
And can you tell us the difference between them, please?
Yes.
Yeah.
And on vertical axis, you would have avoidance and removal. So engineering avoidance would be a renewable project. Engineering removal would be direct air capture. Nature-based avoidance would be cook stove project. Nature removal would be reforestation or soil carbon. And the reality is, 2 weeks ago, actually last week, we received a request from a corporate buyer. Mm-hmm. And they were looking to procure up to 200,000 tons. They're requesting price of less than $20. They wanted this to be nature-based solution aligned with Paris Article 6 agreement. And the reason why they wanted to have nature-based solutions is driven by 3 factors: is price, scalability, and community benefits. So if you look on the price, engineering-based solutions like direct air capture, they trade at $600 to $1,000 a ton. there is no buyers at these prices. Microsoft is buying 80% of all engineering-based carbon credits in the whole world. And at the same time, prices can go down maybe to 200, 100, but it's still so much nature-based solutions cheaper, and they're priced at like $15 to $30 for high-quality ones. The second reason for such preference would be volume. There is not enough engineering-based credits on the market. 98% of the credits on carbon removal comes from nature-based. And the corporates, they just simply want to buy secure large volumes with high certainty and good visibility. They don't want to take a risk on engineering-based solutions delivering those volumes or not. And the last argument for nature-based solutions, why the buyers prefer those, is community benefits. So unlike engineering project, nature-based solutions can deliver such community benefits. As an example, this year Offset 8 arranged financing for a project in Malawi, Africa. The project restores 10 million trees and gives 140,000 cook stoves to local community members. That leads to less deforestation in the same area. At the same time, the project gave local community seed, maize, fertilizers, supports subsistence farming, feeding more than 25,000 people. And this is all the reasons why companies prefer projects like this, because they can deliver 1 million tons of avoidance and removal at a reasonable price, and they integrate community benefits.
I was just speaking at COP16 in Riyadh, the desertification and land degradation COP, and the numbers are staggering, I have to admit. So apparently $419 billion are being spent and wasted every year because of the lack of investment in nature-based projects, which is affecting our livelihood, which is the equivalent, so it's affecting 3.2 billion people around the world just because of that lack of investment. So I'm really pleased to see now that the dial is shifting. So thank you for this. Okay, last but not least, Toddington. Can you walk us through, so technology is so dear to my heart, and I know technology will be the main driver for, for carbon markets, for saving our people and planet. So can you walk us through how tokenization is transforming the carbon markets as we speak? And particularly when it comes to transparency and integrity. These are the two pain points that our clients are mainly worried about at this moment of time.
Yeah, it's essential, and the phrase we hear a lot about and we talk about is net zero. But how do we know when we've got to net zero? How do we actually prove we've got to net zero? How do we chart the journey accurately and precisely? And how do people know that if they invest in this particular solution, in this particular product, they're going to get what they say they're going to get? If somebody comes along with a solution and says it's going to deliver this many carbon credits, going to reduce this many emissions, how do they know that they made the right decision? How is that proven and verifiable? We mobilized, I mentioned in the last business, over £1 billion and delivered a net zero network. But you know that because I'm telling you. And that's not good enough. That's not good enough for net zero, and net zero is law. So what we're doing is we're working on the whole tokenization journey of, first of all, mobilizing the capital and tokenizing the capital. So we can say that capital is now programmable money that we then mobilize into physical infrastructure, which we also tokenize. And so we can track that capital was genuinely invested in that infrastructure. And then the outputs, we also tokenize.
What do you mean by physical infrastructure?
Sorry?
What do you mean by physical infrastructure?
I mean physical infrastructure like electric vehicle charging networks for cars, for trucks, etc. I mean AI data centers. I mean blockchain mining operations that verify blockchains and so forth. So you can verify that the capital was invested into the physical infrastructure, and then the outputs of that infrastructure were also tokenized and recorded. So you can say, that generated in, this many tons of carbon emissions, empirically proven according to standards, verifiable, and at extremely high quality. And that will build confidence. That will deliver the right pricing that we need to deliver this. And that will allow us to prove demonstrably that we can actually deliver, gigatons of carbon. That's going to require, and again, building on some of the comments I heard earlier, what a place to be doing it. Cooperation with government, and the regulator. I mean, what a place. We're building on the DLT Foundation and ADGM, incredible. Support from the government, absolutely fantastic. You need incredibly, clever tech on top of it. And so we're working on some really innovative blockchain technology solutions as well, with a particular one that people don't know so much about called Alephium, which we're very, very excited about. So we can program that the capital was deployed into this infrastructure, the output is then recorded and verifiable, and only by building confidence and actually proving empirically that you are doing what you said you're going to do, are you going to enable and facilitate the flow of capital, you're going to increase the efficiency of capital, you're going to increase the liquidity of that capital, so there can be secondary markets. And it gives us a chance. If everyone has to reinvent the wheel, if everyone has to work out everything again for the first time, we're not going to do it. Because a gigaton of carbon emissions is a very big number. Yeah. I was told to kind of visualize it. It's very difficult to visualize it because a billion, a million and a billion, we just use these numbers quite interchangeable. But I was given an example that in terms of mass, it's the mass of around 200 million elephants, as an example, which is 500 times more, unfortunately, than the population we have on the entire planet. And we need to do 59 of them, so that's around 12 billion tons, 12 billion elephant equivalent, that kind of volume. And we've only got 25 years to do it. And to get to 43% of the way there by 2030, so within 5 years, is one heck of a challenge. And it's only going to be possible with the full support, the alignment, the efficiency, the transparency, and that's what tokenization, that's what blockchain, and that's what AI brings as well, because we also need to optimize and improve and replicate and repeat, and we need to mobilize huge amounts of capital, and it needs to be commercially viable. And anyway, this is the place to do it, and that's why we've launched Gigatons.
The green in me is a fan of AI, but at the same time, I'm worried about the energy that it's consuming. But anyways, I'm conscious of time. Thank you so much for joining me and for answering my questions and for not using a lot of jargons. I appreciate that. And thank you, everyone, for joining us. Take care.